Hello again and welcome to your next video lecture. This is Chapter 8, and in Chapter 8 we're going to talk all about forecasting a budget. It's all about dollars and cents here in Chapter 8. You know, it has been said that any project can get done as long as you have enough resources and enough money to do it. The problem is, as we know, in most real-life situations, there isn't unlimited resources. There isn't unlimited money. So it's a project manager's job to, one, estimate how much a project is going to cost, and that way management can give them the go-ahead or not give them the go-ahead, depending on whether it's worth it or not. And they can use that estimation for an ROI, or return on investment, or what have you. It's also a project manager's job to, once they estimate or budget how much the project is going to cost, it's a project manager's job to bring that project in under or at budget. So not only is forecasting very, very important, forecasting how much it's going to cost and the monies, etc. Not only that is that very, very important, but also bringing the project in on time. Bringing the project in under budget is also very important. So today we're going to talk about different methods of forecasting, different ways of forecasting, and how budgets can get askewed, if it were, as it were, with forecasting. At the end, of course, there are 4 discussion questions, a couple of pages, 2-3 pages on the discussion questions would be great, turned in to me on Monday. So without further ado, let's get into Chapter 8 with budgeting and forecasting. So let's get to cost estimation and budgeting. In cost management, really there's 3 things. There's cost management, there's cost accounting, and there's cost estimation. Cost management is just that. It's bringing the costs of the project under budget. It's encompassing all of the data collection, all the accounting, and all the cost control, and everything else a project manager needs to do to bring those costs under budget. That's called cost management, making sure they're managing every aspect of the project from a financial standpoint. Cost accounting is how they do that. And cost control. It serves as a cheap mechanism for identifying costs and gathering costs and reporting costs to upper management. Remember, costs are key in any project management or any project because, generally speaking, managers will either give the go-ahead for the project or not give the go-ahead for the project based on an ROI, or a return on investment. So they're going to take a look at how much a project will bring back to the organization, either in current financial standpoint or future. And it might be revenue, it might be expense savings, it might be cost savings or something like that. And they'll look at it from now and also in the future. And then they'll compare that with how much the project is going to cost, including all the direct and indirect costs, etc. And then they'll determine whether it is a feasible project or not. Cost accounting and cost control is, generally speaking, the mechanism for the project manager to use when they are recording the cost. And then finally, cost estimation usually happens before and during the project. Generally speaking, a project manager is going to have to go to the management team and estimate how much a project will cost. And that process creates a regional budget baseline so that managers can make a decision on whether or not to proceed with the project. So really, the costs of a project come under these 5 buckets. There's labor, and those are the people directly working in the project. And that includes project manager, all the project manager's team, and then any other labor that they need to do. In other words, let's say they're going to bring in a new machine, the labor to bring in the machine and install the machine, and all the other labor that is associated with the cost. There's materials. And those materials are sometimes can be raw materials. Sometimes those materials can be equipment materials, long-term materials, capital equipment, and things like that. Subcontractors, which are people that don't work for the particular company but need to be brought in order to help with the project. Subcontractors can include construction people. They can include people that set up the machine, millwrights, etc., etc. Equipment and facilities. And facilities is really it can even be the meeting room in which people meet for the project teams. So equipment, we talked about equipment, but facilities is really where the project is housed and where the people are housed. And then finally, travel. Oftentimes it's important for project teams to travel, especially if they are not in close proximity. At least travel maybe once a quarter, maybe once a month, depending on the project, in order for them to be a cohesive project team. And we talked about project teams and being a cohesive project team in a previous chapter here in project management and during the semester. So the types of costs are direct versus indirect, and we're going to get into these buckets in a minute. Recurring versus non-recurring, fixed versus variable, and normal versus expedited. Direct costs are those costs that are directly involved with the project, like labor, like the project team's salary, the project team's benefits, etc. Indirect costs are the facilities maybe that the project team is housed. Indirect costs can be the heating bill, the light bill, other expenses that are needed that are indirectly related to the project team. Recurring costs are those costs that recur all the time. Non-recurring costs are one-time setup charges or setup costs, like the cost of bringing in the equipment and writing or bringing in the millwright to write the equipment would be a non-recurring cost, but the recurring cost would be the energy to run the equipment, the labor to run the equipment, etc. Fixed versus variable cost. Fixed costs are those that are fixed, like the facilities, like salaries are fixed, etc. And variable costs are those costs that vary with how much output the project is doing. And then normal cost versus expedited cost. Expedited costs are those costs that you have to bring in order to get the project done under time. Expedited costs might be expediting shipments. Expedited costs might be paying more in order to become high priority from a supplier or something like that. Those would be expedited costs. So those are the types of costs. So in the last one you had the buckets, and now here's the types of costs. So table 8.2 kind of summarizes what I said with regards to cost classification. You've got your direct labor costs. Those are direct, they're recurring, they're fixed, and they're normal. Building lease would be indirect costs. It would also be recurring. It would also be fixed. Expedited costs are direct. They're non-recurring because you're going to expedite those to get the project done. And they're expedited, obviously. Material costs are direct costs, and they're recurring. They're also variable. Raw materials are variable depending on the output, and they're normal. So kind of gives you the buckets as well as the type of cost clarification in a little matrix there to help you with regards to understanding each one of the costs. So now let's talk about cost estimation. Cost estimation happens throughout. So a ballpark cost is basically when a project manager goes to management, etc., and gives them a estimation or a ballpark, and which means a kind of a close estimation, I guess, or an order of magnitude estimation how much the project would cost. Basically, a ballpark cost should come within 30%. So you should be within 30%. So if you go to management and say, I think, and this is before the project even starts, before you even look at the type of resources and the type of material you're going to need, if you look at management and you say, I think that this total cost is going to be about $1.75 million. That is a ballpark. It should come within 30%. You should be within 30% accuracy. Comparative costs are those costs that you're going to compare with other projects that are done similar. That should be within 15% accuracy. So a project manager could say, this is phase 2 of the project. Phase 1 costs $857,000. I think phase 2 is going to come in at $925,000. So it should be within 15%. The cost should actually come within 15% of that $925,000. A feasibility cost usually has feasibility studies in it. And with feasibility cost, you're trying to get a better accurate estimation of the cost. So basically, you do some research, you ask some people, you take a look at some comparatives, you take a look at what's happened in the past, you take a look at what could happen in the future, etc. You do some research, you start looking at what type of resources you need, etc. And you do a feasibility study or a feasibility cost estimation. That should be within 10%. And then when all's said and done, and you're going to have to excuse me, I've got to sneeze. Sorry, I'm back after a magnanimous sneeze there. And then finally, the definitive estimation is when you go to management and you say, I'm going to bring this project in at this cost. You should be within 5% over and under. And generally speaking, management is looking for 5% at that point in time, because at that point in time, management is going to make a decision on whether that project is feasible or not, or whether to go ahead of that project. If you're not within 5%, management tends to be very upset with you, because remember, they're basing this on an ROI. They're basing this on some things, on how much it's going to bring back to the organization, how much the organization is going to benefit for it. Oftentimes, they need to go to a bank, or they're going to need to go out and raise capital for the project. And if you're outside of that 5%, it really throws a monkey in all of the works. So basically, with regards to your cost estimation, when you come in at a definitive cost, management's looking for 5%. Actually, most managers, if you're a good project manager, if you're worth your salt in project managers, many of those managers are looking for a project manager to come in exactly at that definitive cost. So progressing on now for things that can actually help or hinder different projects for costs, etc. The first thing we're going to get into is learning curves. It has been said that learning curves reduce project management costs significantly. And actually, there's actually been a formula that has been developed to take a look at learning curves. Now, this is learning curves for project managers as well as project team leaders as well as the project team themselves. And it says that each doubling of output results in a reduction of time to perform the last iteration. So what it's saying is learning curves reduce significantly the time and the money it takes to complete a project and to bring a project in on time. So the formula is y of x equals a times x to the b power, which means y of x means the time required for a unit of output or a project to be done. A is the time for the initial output. X is the number of units to be produced, and B is the learning curve or the slope. So what it's saying is learning curve or the slope logistically can speed up a project. And that's where you get the the x to the power of b. You really don't necessarily need to understand that formula in order to calculate different times based on learning curves, etc. The key concept here, though, is learning curves greatly reduce the time, greatly increases the output, and greatly reduces the cost of any project based on how much experience the project team has and the project leader has. As you can see by the next slide here, this is a graph on the unit learning curve log linear model, which shows that as the repetition increases, the time and the costs go down exponentially. It is not a linear model where it goes down on a linear basis. It's actually a curved model and a logistics model which says that with repetition, with learning curve, the time and the cost are reduced exponentially. So here's some problems with the cost estimation. First of all, really there's 5 buckets here, but there could be any problem with cost estimation. And the first one is low initial estimates. When you don't do a good job of your feasibility study, you don't do a good job of your definitive cost estimation, and now you've estimated too low, and all of a sudden your feasibility study was wrong and the project comes in way over budget. Therefore, many project managers will actually hedge their bet or hedge their budget and increase their budget a little bit so this doesn't have to it. Unexpected technical difficulties. There's all types of things that come to be unexpected in the project, whereas you think that it's easy to do one particular part of the project. Technically, though, it becomes very, very difficult. Sometimes there's not good software in order for you to complete the project. Sometimes technical difficulty rises with space. You can't get a machine in. Technical difficulty is that one machine doesn't work well with the other machine. Or technical difficulty is the machine might be too difficult to run and it takes a lot of extra training or something like that. So technical difficulties, unforeseen mostly technical difficulties, is another reason why costs come in over. Lack of definition, again, we talked about that with low estimation costs. Lack of definitive costs, lack of definition can really screw with a project cost estimation. Specification change. We talked a lot about this when we were in class. We've talked a lot about this as we move forward. The scope creep can really derail a cost budget. You go into a project thinking you're going to accomplish this, then all of a sudden you get scope creep, you get creeping elegance, and now you're not only accomplishing this, but you're trying to solve world hunger, you're trying to boil the ocean, you're trying to do all these things that are impossible to do. Specification changes within the project, specification changes within the scope, all those types of things will make your costs go out of whack. And it's up to a project manager to stay firm with the initial project scope and with the initial project charter. That's why way back when we first got together, we talked about project charters, we talked about project scopes, all those types of things. Way back when, it's important for you to, or for a project manager to get with the team, come up with a project charter, including a project scope, including of the current state and the future state and everything that has to do with that project charter, including a cost estimation, and then communicate that to everybody in the organization, all of the stakeholders and all the project stakeholders, so they know what's going on. So therefore, you don't get specification changes, you don't get scope changes, etc. And then finally, external factors can happen to derail a project. You can get environmental factors, snowstorms, plant shutdowns, etc. Other external factors such as competition comes in, which might force a scope change. Sometimes you got external factors like you've got vacations, you have people that move from job to job, you got people to leave the company, you got people that you've got to hire for the company. All those external factors can also derail cost estimations. And all those things a project manager needs to consider when they're doing an estimation. That's why from a definitive cost, we say it's plus or minus 5%. Oftentimes, as I said before, a project manager understands this. A project manager understands that there's always unforeseen factors that can get involved, so they might hedge that 5%. So it is the project manager and the project team's job to create a budget. Oftentimes, the financial person within the project team is responsible for the budget with input from the project manager, with input from the project team, etc. As they start working on their project Gantt charts, they start working on their action items, etc. It's important for a project team to come up with a project budget. The budget is nothing more than a plan that identifies the resources, goals, and schedules, as well as the costs that need to be followed in order for the project to come to fruition. Sometimes those are top-down, where they say, okay, this is how much it can only be. You've got to bring it under this budget. So management might give a project team a project and a budget and say, your budget has to be this. You have to come in under budget. Sometimes it's bottom up, and sometimes, and most of the time it's bottom up, where a project team will come up with a budget and present it to upper management. We talked about that when we talked about the things that come into costs, etc., a few slides back. And then sometimes it's activity-based costing, or ABC costing, which is basically costing out all of the different activities that's going to have to happen for the project to come in. So in each activity, each action item, everything that has to be done, they put a cost to that. It rolls up the cost to a total cost, etc. And that becomes a budget, and it becomes a activity-based costing budget. So really the three things is management says, I'll give you a budget. It has to be this much. Or project team says, this is my budget, it's going to be this much. Or they come up with activities and they say this is how much each activity is going to cost in order to get this project done, and the budget is going to be this much. So more on activity-based costing. Projects use activities, and activities use resources. So you assign different costs to activities that use resources, and you assign costs to that activities and those resources. You identify the cost drivers associated with those activities. You compute a cost rate per cost driver based on the transaction of the activity, and then finally you multiply it together, and that's your activity-based costing. I'm not trying to make you all accountants here, and many of you who have taken accounting know about ABC accounting and activity-based accounting. The key concept here is that you can use the same method when you're talking about budgeting or forecasting budgets for project management. So the next few slides we're going to see some sample project budgeting. This one is based on activities. It's got direct costs, budget overheads, and total cost. So survey, for instance, is your activity, and this is all based on activity-based costing. The direct cost, which would be labor and other things directly associated with the activity, would be $3,500. The overhead cost, which is assigned to, say, land or assigned to factories or some other overhead, which might be some other salaries, etc., is $500. So the total cost is $4,000. And you can see for each one of the activities from survey all the way to plumb and wire, including the design, the clearing the site, the foundation, the framing, etc. You can see that you have direct costs in each one of those. You have overhead, and those are your total costs, which gives you a budget based on the activities that have to be done in that particular project. Here is an example of your planned and actual budget based on your activity-based costing. So if you take a look at the last one, say survey, remember, was $4,000, the planned. So you do a what's planned and what's actual, and you try to do a variance. And this is a running variance as you move towards the end of the project. This is really important because as you do a running variance, you can see whether you're over or under budget, and you can continue to update management, upper management, to see whether, to let upper management know whether you are going to come in under budget or whether you're going to come in over budget. So with activity-based costing, it's really good in the respect that not only can you forecast what the project will cost and the budget of the project, you can also continually update the project stakeholders as well as the other stakeholders as to where your budget will come in. And then finally, this is an example of a time-phased budget with both the actual costs actually coming in, and then also the forecasted costs. So if you're in January, you'll know that the actual cost for survey was $4,000, monthly planned was $4,000, and cumulative. In February, you'll know the actual plan for design and clearing the site, but you can also budget for what's going on in March, April, and May. So it's an example of a time-phased budget. And then this slide just tells you that you can graph the budget and continue to keep a graph of your time-phased budget on a monthly basis. You can do it on a monthly basis, you can do it on a weekly basis, you can do it on a quarterly basis. It all depends on what management requires and what management wants of you based on how big the project is and how important it is for coming under costs. So the final concept we're going to talk about in this chapter is budget contingencies. And we're going to talk about what budget contingencies are and why budget contingencies are important. Budget contingencies are the allocation of extra funds. So oftentimes when you have a project, you have a budget, and then generally speaking, you ask for a bucket of budget contingencies. Those are some extra funds for when things go wrong. Remember, we talked about how costs could go over with technical difficulties and external factors and other variables that you could not foresee. So basically, you look for contingencies or budget contingencies, and oftentimes a project manager will go to a upper management and say, here's my budget, but I'm thinking I'm going to need contingencies of about X percent. And it's either expressed in a percentage or sometimes it's expressed in a dollar figure. So budget contingencies are the allocation of extra funds to cover uncertainties and improve the chance of finishing on time. Oftentimes now a project manager, and that's a really key thought here, project managers will also oftentimes say, if you want me to finish on time, I'm going to need contingencies. If you want me to finish on budget, it might run overtime. So oftentimes, if they do have some unforeseen costs or some unforeseen factors, managers, upper managers then, can determine whether they want to throw more money at it to bring the project in on time, or whether they can let the project slip and keep it under budget. So that's what budget contingencies are for. They're needed because project scopes may change. Oftentimes, because we are not in a static environment, we're in a very dynamic environment with the market factors changing, competition changing, the economic factors changing, and really the global marketplace on a altruistic basis is changing. Sometimes the scopes have to change because a project might take 8 months, and by the time the project is done, it's changed so much that the original scope of the project isn't needed anymore. So based on that, you're going to need contingencies. Murphy's Law, if things could go wrong, they will, is often present. Cost estimation also has to anticipate interaction costs, interaction amongst people, and whenever there is people involved, whenever there's a human factor involved, there is always variables involved. And then also, budgets are done under normal conditions. And we all know that generally speaking, there is nothing normal in the business environment. In the business environment, there are always variables. There's nothing that happens on a normal basis. Because that is, budgets are done on a normal basis and no one can see the curveballs that are being thrown at them, budget contingencies have to be made. And again, those contingencies can either be time or they can be money. If you want the project in on time, you got to throw more money at it. If you want the project to come in at budget, sometimes a project may slip. So benefits to contingency funding will, one, ensure the project comes in on time. Sometimes time is way more important than money. So if you have to have, let's say you've got to launch a new product before your competition does, and a month later you're a dinosaur. If it's a month late, you're a dinosaur. The competition's already got the foothold in the marketplace. So in that particular case, you need budget contingencies because you got to bring it in on time. The other benefits to contingency is it also can recognize future unknowns and deal with future unknowns. It can add provisions for company plans and also applies contingency funds for early warning signs as things start going awry. So that concludes the concepts that need to be discussed in this chapter of forecasting and budgeting. As you can see on the slide in front of you, these are some summary statements and what we tried to accomplish over the last 30 minutes or so in this video lecture. You can put these on pause and review these or review them some other time. And the concepts that are here are some of the things that will be tested on in the next quiz. With that, here's your discussion questions. Again, a couple of pages will do, and turn them into me when we get together again on Monday. And until then, I hope you have a great week, and we will see you next Monday.